So as with the turn of any new year, investors are always focusing on the future. What's next for markets and what can we expect from our portfolios in 2023? I can't think of any question that I've been asked more often than what do you think the market will do this year? So let's try to answer it. Before we do that, let's take a look back at what's happened in the last 3 calendar years. Remember 2020, hard to forget. COVID year, market was very volatile, ended up having a very positive experience both in the US and overseas. 2021, we saw that continue. Economies reopened, markets responded positively. And then we hit 2022 last year. It seemed like the wind came out of the sails for markets a little bit. Although in the last quarter of the year, we started to see some signs of life. Then this year, things have started with some encouragement, at least in the first 3 weeks, but we have a long way to go. So the most popular question this year, like every other year, is still, what do we expect the market to do in 2023? Now, to help us answer this question, I've asked Ryne Oller, a lead advisor here at Foster Group, to share the findings on some data that he looked at in anticipation of investors asking this very question. So Ryne, thanks for being here today. So we'll talk about it in a minute. It's pretty special that you're here. But hey, I know you took a look back at market data going back as long as we have it. And we're talking about the US stock market. So when we refer to the market, we're talking about the S&P 500 index. But we have data going back to basically 1926. So tell us what you found in all that data that might help us to form some expectations for 23.
Yeah. Well, last year was a really tough year. So naturally, the question is more than ever, what can you expect this year? And that's my client's favorite question to ask me is, what can I expect this year? Or what do you think? And frankly, that's an impossible question to answer. I think everyone knows we don't have a crystal ball, but for me, kind of the starting point to trying to answer that question is just understanding kind of history. So right here, what I did was just go back and look at every single calendar year for the S&P 500 to get a sense of what has history done in the S&P 500. And you can see here, it's a lot of green, a little bit of red, and we've got that long-term average of about 10.1%. And so just if we're to answer the question in terms of what has happened historically, about 73% of these years are positive. Again, that average of 10%, and then 27% of those years are negative. So when I'm building a financial plan for clients, I have an average number that's kind of baked into forecasting what does the future look like for them, and then we're going to make decisions based off of that average number. But in terms of kind of expectations year to year, using an average number, whether it's 10 or 7, 6%, whatever it is actually a really bad way to manage expectations. So,
yeah, I like that because what we're going to see here in a minute is that while the average may be 10.1%, we don't often see the average return in any given year. And that's, I think, what you're showing here in this chart.
Yeah. So the number of times that the S&P 500 has been within 1% of that average is only twice.
I think that's amazing, actually. Just an amazing.
Just 2 years here. You can see 1993, 2004, they were really close to that long-term average. Otherwise, it hasn't been all that close.
Now, you've got a personal story here that kind of relates to how this works, because here we see the average return or the expectation. You'd think, well, be around the average of 10%, and yet we hardly ever hit right on 10%. I know that you're here today, and I'm glad you're here, but there's a reason why we thought, well, he might not be here. So tell us a little bit about that.
Yeah. So today, January 23rd, is the due date for our third child. So Kent asked me a couple of weeks ago, hey, I've got this idea for a video. Do you want to join me? I said, yeah, I'd love to do that. I'll be there. Just one thing you need to know is that is our due date. So his eyes kind of perked up and he thought, oh, well, maybe I won't see you then. I said, well, maybe not, but probably will. The reason for that is my 2 other children were 2 weeks late. So, I mean, the odds of anyone giving birth on the baby's due date's about 5%. Did a Google search, they said 5%. And funny thing is that's basically the odds historically of any calendar year hitting its long-term average. So the odds are about the same.
Well, I'm glad you're here.
Yeah.
We got a few more things to talk about, and then we'll let you go just in case something happens today. But I did really like the tie-in to this picture where we see, hey, the average return, while it's 10%, when we talk about the S&P 500 as a measure of the U.S. stock market, we don't see the S&P actually return that 10% very often in a calendar year. So tell us a little bit about the positive and negative years surrounding it.
Yeah. So right here, we're filtering on just positive years for the S&P 500. You can see, again, there is a lot of green. And when it's green, it tends to be really positive. And so What I'm also seeing here is that those positive years tend to be bunched together. There's not very many standalone positive years. In fact, there's only 2.
Mm.
And if we filter on just negative years here, again, there's a few of them. It's about 26 instances. What's interesting is there's not a lot of clustering. There are a few, really tough stretches in there, but there's 12 instances of back-to-back negative years, which means there's 14 standalone.
Yeah, I really like that in terms of this bunching. But I think the thing here to remember is when we look at this chart compared to the one right before it, the number of positives outweigh the number of negatives. It's that 70%-ish kind of number. And then, so the fair question I think that people are asking this year, though, is, hey, what happens after a negative year? So on this chart we see those gray dots, which represent the year prior to the return represented by the bar. What's this showing us?
Yeah, so you can see here on the gray dots, those are all negative years. They're all below that kind of dark line. And then the next year shows kind of what the return was. And you can see again here, a lot of green, some red. Statistically in the S&P 500, the subsequent return after a negative year has been positive about 70% of the time, negative 30%.
It's really interesting. And again, we just keep looking at that nice flat 10.1% average return over the entire time period, but we don't see any returns really in this chart that are right on that average return still.
Yeah, so this table here just kind of breaks down the stats on the left-hand side. Let's look at all 12-month periods and what historically were they positive or negative. 76% of those periods were positive, 24% negative. And now we're just going to cut the data and look at, well, what if the prior 12 months was positive? What were those same odds of it being positive or negative? And then the far right is, what if the prior 12 months was negative? What are the same stats? You can see here that, the percentages diverge a little bit, but they're really close to being the same as any other year.
So that far right column is really the period we're talking about right now. We've just had a negative year, prior 12 months or so, and the percent positive has been 70%. So the expectation, if you're just going on historical averages, you'd say, well, 7 out of 10 years, we could expect maybe a positive year. No guarantee that's going to happen, but that has been the case in terms of how history has worked out in the S&P 500. So what do you kind of take away from this, Ryne, when you tell your clients like, hey, here's how you should think about it, what you could expect from 2023?
I think any year coming off of a positive year, negative year, you should expect volatility. Historically, that's the story that's being told to us, is that the stock market is very volatile. But I think there's also a story that you should have some room for optimism. We can prepare for volatility, but expect positive years based on the historical data.
I completely agree with that. So one of the things we talk about all the time is the future is always uncertain in terms of our ability to predict what's going to happen immediately next. But the long-term history would say, we have a reason to be optimistic about positive returns in the future. We continue to believe that as well. We wouldn't want to make a prediction about 2023, but the data would say, well, hey, there's reason to be an optimist. There's reason to stay invested. We hope that you do. And we hope that you stay diversified as well. And Ryne, thanks for being with us today. Seems like we made it without a phone call, so we'll let you go. Hopefully we'll have some good news here shortly.
Yeah, thanks, Kent.
All right. Thank you.